Hello and welcome to a Diary of a Trader. Today we're going to go over Renko bars and how they are traded, how they're different from candlesticks, and what are some good strategies to use with them. What we're looking at right here, and I would suggest you go to a brand new chart in TradingView, and I'm just looking at the XAU USD chart, and this is the gold dollar CFD chart. And I have a regular candlestick chart, and we are pretty familiar with these. This is a very common way to look at the markets. If we look here, we see that one candlestick represents a period of time, and that the time spent or the price activity inside of it kind of tells us a story. So a candlestick does not form until a certain amount of time has completed, and so we are on a 1 hour chart. And so a candlestick will not form until the whole hour has passed. Now, an alternative way to look at charts and price action is something called Renko. Now, Renko charts, they are different in that they do not account for time at all. Time does not matter, all right? Renko is formed using bricks. So you can see these are just square or rectangular bricks that form. And how these are created is using a set amount of points or pips or satoshis, however you want to call them. For right now, a brick in this chart will only form when $5 worth of movement have been traded. So if I look here and the box size or the brick size, they call it the box size, the size of the box of the brick I want to say is $5. So, or actually let's change it to 10. $8. So it's $8. And, well, if that's what's features, actually let's just stick with 5. It's a little easier. Excuse me. So we've got a $5 Renko brick set up. And so what that means here is, if we look, is that right here, if we look at the open up here in this corner here, we see that the open was at 125 and that the close was $5 above that. The close is at 1,255. And the one after this opened at 1,255 and it closed at 1,260. So you can see that every $5 of movement we see price moving up. The same thing applies to a down move. So when prices move down in Renko charts, it has to move down $5. And so we have an open at 1,270, close at 1,265. So the next one means we opened at 1,265 and we closed at 1,260, and so forth. Now, what makes Renko so important and what makes it so effective is that when it changes color, it's kind of a big deal. It's not just a random thing that happens, because, well, if I look here, it says, well, I went from red to green, so I moved $5. You didn't really, though, because remember, this red brick had to move $5 down to create a red brick. So then it had to move $5 up and then another $5 up to form this green brick. So we had to move $10 of movement, so twice the normal Renko brick, in order to finally create the new brick. All right, and then it moved up before promptly falling back down. But we can see that in the great majority of cases in large trend changes, we can see that the change of color of Renko bricks indicates a high probability of a trend change in the long and short term. The trick is, we cannot really trade off of this by just saying, well, whenever a Renko brick changes color, then I'm going to take a trade. We need to use other sources of analysis. So that's where, using some type of indicator is going to come in handy. So maybe the stochastic RSI would be of help, and maybe the RSI itself. And so what we want to look for, and what we should probably draw first is, as I'm pointing this out, that Renko, compared to candlesticks, it reduces a lot of noise. And it's easy to spot and plot areas of support and resistance. So, I can see that there's been a lot of price activity traded in that area. I've seen that we've got some double tops around this area. We've had some lows and support found down here. Probably in this zone too. And when we've had those drawn and we see how price responds to those zones, if we have predetermined areas of pivots, we can just look at our chart's price action with the Renko and let's compare it to what is happening with some of our oscillators and our indicators. So I see right here that price was trading up and then it fell down, and then I noticed that the stochastics was in this extreme condition of being oversold. But the RSI was not yet. The RSI was still in a position to say, hey, we are weakening, but we're not really overdone yet. So while the stochastic stayed, which it often does, it stays in this oversold condition, the RSI came to here. And it got right on top of that real default zone for being oversold. And then when we had it slope up, we had our first indication that prices were changing. And when that green Renko brick formed, we knew that we had a high probability of a uptrend to go and continue for a while. We can see this repeated over and over. This is a very simple, easy, and effective strategy that you can use and implement into your trading. Again, Renko is a very, very simple way to view the market and to trade the market, and it's less noise. You don't have to do a lot of interpreting with candlesticks. You don't have to do a lot of guesswork with the candlesticks either, because this price action here, if we highlight it, this entire price action in this area, wrong one. All of this is no different than all of this. All right, do you see how much different that is? This highlighted zone that I highlight in Renko is the same as this highlighted zone with candlesticks. So I would leave it to you to determine which of these seems less stressful to trade. One is a whole lot cleaner. The other is a lot messier. And if anybody who trades candlesticks on a regular basis knows, you can get really frustrated with the candlesticks and how they move. And you can get stressed out and exit or enter trades too early or late. Renko really keeps you focused on just the price and following a few rules make this a very profitable charting style and a very profitable trade strategy. Thank you for watching. Bye-bye.